Hey everybody, hope you're having a good evening so far. We're going to wait about 30 seconds for those who would like to join us live, and then we will get started with tonight's training. Okay. All right, let's get started. My name is Brenton Harrison with Escape Student Loan Debt. We are an online education company with trainings that offer step-by-step debt reduction and debt elimination techniques for federal and private student loan borrowers whose payment or balance have become a major barrier in one area of their lives. It could be their dreams of homeownership. It could be their credit. It could even be their relationships. No matter what it is they're dealing with, we offer trainings to meet that objective. In tonight's training, we want to tell you a story about a student of ours named Kendall. Kendall came to us as a resident in the LA area, and they were posed with a unique situation, a unique problem that on the surface would be a good thing to have. But when you dig into the details, there was a lot of consternation about the next move that they should make in terms of their career. Here's what was going on. Kendall was working a job, and they were making really, really good money in their job, but they also had federal student loans. Now, for the past few years, one of the things that Kendall had been building up to was the dream of homeownership, and they had narrowed down where they wanted to live to a particular area in LA called Silver Lake. This is a very expensive area, very nice area, a lot of cool homes, but a very, very high price point. And Kendall was making sure he saved up all his ducats, made sure he had everything in a row so that at a particular point in time, he could pull the trigger. He had the down payment money. He had the income that he needed to get that home. Now, as he was saving for this goal, he got a job offer that really took him by surprise, and it was structured in a very unique way. If he were to take this position, he would actually find out that his base pay would be decreased. So he would technically, on paper, at the beginning of the year, be making less than he was at his current job. But this job came with the potential for huge bonuses, up to an amount where if he took them and got all the bonuses, he would more than double his current pay. Love the job, love the company, definitely love the idea of having bonuses that would double his pay. So it would seem like it would be a no-brainer for Kendall to take this position. Now we start to talk about, if it's not a no-brainer, why isn't this something that he would just automatically do? Well, there are two principles I want to give you that illustrate why this actually became more of a decision point for Kendall than you would expect. First is debt to income ratio. Second is the payment he was making on his income-driven payment plan for his federal student loans. Let's start with debt to income ratio. Debt to income ratio is an expression of how much of your monthly income is swallowed up by your monthly debt payments. If you have a $10,000 monthly income, but $5,000 of monthly debt payments, you have a 50% debt to income ratio. And debt to income ratio is one of the most important factors in deciding not just if you get a home, but also how much home you can purchase when you go to a lender. As an example, when you get your credit score checked, your credit score determines if you can get a home loan in the first place, but the interest rate that you're going to receive on that loan. But your debt to income ratio determines how much home you can actually buy, because a lender wants to make sure that you don't overextend yourself. They want to make sure you're not over leveraged. They want to make sure that in a pinch, you can pay them their money back first, no matter what's happening in the rest of your finances. So with debt to income ratio, they want it to be as low as possible. They want your current obligations to not be something that will prevent you from paying back your mortgage. It's one of the most important factors. And what Kendall found is that because he was having a decrease in his base income at his new job, that new base pay would put his debt to income ratio in a position where he would no longer qualify for the amount of money he needed to buy in Silver Lake. Just to recap, goes to get the new job, even though he was going to get paid more eventually, because the bank is saying, well, that bonus isn't guaranteed. We're only going to base your debt to income ratio off of your base pay. And when they did that, He did not make enough and his debt payments were too high, so he would have been priced out of Silver Lake. Seems very odd. I'm making double what I'm making now potentially at this new job, but somehow I'm priced out of this neighborhood where if I stay where I am, I'm not priced out. Here's the other thing that came up, the payment he was making on his federal student loans. Because we have talked about in these videos how, fortunately or unfortunately, the payment that you make on federal student loans is often one of the most flexible things in your finances as it comes to debt and needing to adjust your payments. It's very hard to adjust your credit card statements. It's very hard to address how much you pay on a car loan. But with income-driven plans that are offered by the federal government, it is one of the rare forms of debt where from year to year, you could have major swings, higher or lower, in terms of what you pay. When we looked in this debt to income ratio, we found out that if we were going to make some changes, the easiest place to do it, again, was with the student loans because we couldn't change radically the payments on any other form of debt that he had under his umbrella. Now, when we looked at that debt to income ratio that the bank was considering, we also figured out that the student loan was the biggest problem. It was the biggest payment that Kendall had. So it was what needed to be addressed first. And we did some things that, in my opinion, I think are pretty cool. I'm not a big toot your own horn person, but I thought that this was a unique strategy. Here's what we did. We have talked about that with these income-driven plans, there are certain trigger points where if you have experienced that life event, you can immediately go to your loan servicer and you can ask them to recalculate your payment. Kendall was going from one job at a certain pay to another job at another pay. And even though he would eventually get paid more at his new job, right now his base pay decreased. So the second he took the new job, we called his student loan servicer and asked them to immediately recalculate his payment based off his base pay, which was lower. So we saw a decrease in his federal student loan payment, even though at his new job, he would potentially be making 100% more than he was at his old job. When we did that, we then went to his lender and said, hey, we would like you to recalculate my debt to income ratio based on the fact that my student loan payment has decreased significantly. And when they recalculated the debt to income ratio, Kendall's debt to income ratio was now within the guidelines of what he would need to borrow and lend and get a home in Silver Lake. So to recap, he has gotten a job where he will be making double what he's making now, but his student loan payment decreased when he got that job, and he was able to get the bonuses, have the lower payment, and get the home of his dreams in his neighborhood of choice. We've talked about this, but this is the power of not just having the loans and knowing your repayment plan, but knowing the things about that repayment plan that allow you to make adjustments when needed so that student loans are not the thing that steer the ship. They're just the thing that are one component of the rest of your financial picture. My name is Brenton Harrison. If you enjoyed this training and you are an established professional whose student loan balance or payment has become a major barrier in one impact of your life, I invite you to check the link at the end of this video and at the bottom of this video so we can get started on a solution for you. I'll see you again soon.